So we are creeping out of this near term, well, daily, this near term daily bullish trend. So as you can see, we've crept out of it. It was supporting up until this point. So this was a bullish trend, but the initial balance for the week has been unfavorable to that. It's slid out of that trend, but the structure on the daily chart, at least, is over here. So the market would need to break below this structure, 79, 17992. We have support, potential support at these prior highs. So I'll mark that on the chart as well. We're testing those at the moment. So 182.12 or thereabouts. So what we're looking for, if the downside is to play out, is a break below, maybe a retest, a continuation down into this point of interest. On the upside, meanwhile, there is a monthly level there. Draw. This whole box is a target area, really. So back to the daily. So on the upside, the initial target is 184.25, and we need to break below 182.12 for 17992. All of this on the right hand side, as you're seeing. That's the daily outlook. In terms of with a bias now flip bearish, with the hourly outlook, it could be a scenario whereby we've essentially what's happened is we've moved into the start of the weeks, or towards at least, lows. So all this length that was being built Monday, Tuesday, Wednesday, move up into resistance. We came out of this consolidation. We retested it as resistance, and we subsequently sold off in a typical fashion in a long squeeze. We are on the front side of that move, obviously, and the price could quite easily correct from support. So this all in here, acting as support. Um, we've got a point of interest on this hourly chart down here specifically. And there are going to be stops below the lows of the week, which is down here, 81.68. So we could see a scenario such as a move up from support, maybe as far as up to towards the trend line, taking out lows. This sort of scenario potentially over the next number of sessions, days, rest of the week. We may find that that acts as initial resistance, or the area on that candle. So that's one scenario. Another would be just to remain consolidated within this range. Without the breakout. Another would be perhaps lower. This sort of scenario, just remaining within the range. Fundamentally, you would argue. I mean, this move today has come from cable. Cable has dropped despite hawkishness at the Bank of England. You've got solid US data this week. It's playing into the Fed. Um, Markets are in anticipation of the potential of a second rate hike later in the year, maybe September. And that has fueled the US dollar running higher, finding support in the W formation's neckline on the daily chart. Um, there's support in the US dollar. But the move in cable is pretty dramatic today. That's occurred from Asia falling out of the consolidation, and that could have further to go. It's come down to 61.8. Retracement of the daily. It's come out of that consolidation, nice firm drop into the 61.8. Fibonacci retracement of the daily leg, that impulse. So it's come down into this support area, and that has obviously weighed on sterling yen. But it's pretty bizarre considering the hawkish sentiment around the Bank of England. The Bank of England um, is on the back foot. You've got the UK's 8.7 inflation is persistently above the bank's 2% target. So you'd expect that to keep the Bank of England on high for longer rate path in stark contrast to the Bank of Japan. So you'd expect sterling yen to hold up, and we'll just have to wait and see how this plays out. But this was a move that was called earlier in the week. This M formation was noted. I think even in yesterday's analysis that we talked about this. Dollar yen, on the other hand, is creeping higher. So that should buffer the cross. And if cable, I mean, cable would have left a lot of imbalance behind on that move. Broken structure on all time frames. So you've been in anticipation of a correction, and that should keep sterling yen buoyed for the time being.